Most people believe investing must be loud, exciting, and full of constant action. They chase headlines, follow trends, and jump between opportunities hoping to strike it rich. But the truth is different. The most powerful investment strategy is often quiet, simple, and almost invisible. It doesn't rely on hype or fast gains. Instead, it works slowly in the background, building wealth year after year while most people ignore it completely. The quiet investment strategy begins with patience. Wealthy investors understand that real growth rarely happens overnight. Instead of chasing quick profits, they focus on steady, long-term progress. They buy assets with strong fundamentals and allow time to do its work. While others panic during market swings, patient investors remain calm, knowing that consistency and discipline often outperform excitement. Another part of this strategy is ignoring the noise. Financial media thrives on urgency and dramatic predictions. Every day brings a new must-buy stock or warning about a market crash. Quiet investors avoid reacting to every headline. They focus on long-term trends rather than daily movements. By filtering out distractions, they maintain clarity and make better financial decisions. Consistency plays a major role in quiet investing. Instead of investing only when markets look attractive, disciplined investors contribute regularly. Month after month, they add funds to their portfolios regardless of market conditions. This habit removes emotion from investing and allows them to accumulate assets steadily over time. The power of compounding is the hidden engine behind this strategy. When earnings are reinvested, investments begin generating their own returns. Over time, those returns create additional growth. At first, the progress seems small, but after many years, compounding accelerates dramatically, turning modest investments into significant wealth. Quiet investors also focus on quality. They prefer strong businesses, reliable funds, or stable assets with proven long-term potential. Instead of gambling on speculative opportunities, they choose investments with real value. This approach reduces risk and increases the likelihood of steady growth over time. Another overlooked principle is cost control. Fees, commissions, and unnecessary trading can quietly destroy returns. Smart investors pay close attention to expenses. They choose low-cost investment options and avoid frequent buying and selling. Keeping costs low allows more of their money to remain invested and compounding. Diversification is another quiet but powerful rule. Rather than putting all money into a single investment, disciplined investors spread their capital across multiple assets and industries. This reduces risk and protects portfolios from unexpected events. When one sector struggles, others may continue performing well. Emotional control separates quiet investors from the average market participant. Markets move up and down constantly. Fear and greed often drive poor decisions. Quiet investors resist these emotional impulses. They stick to their strategy even during uncertainty, allowing rational thinking to guide their actions. Long-term thinking is essential to this strategy. Instead of focusing on short-term profits, quiet investors evaluate investments based on their future potential. They think in years or even decades. This perspective allows them to benefit from economic growth, innovation, and the natural expansion of markets. Another quiet habit is continuous learning. Successful investors spend time understanding markets, businesses, and economic trends. They read books, study financial reports, and analyze historical patterns. Knowledge strengthens their decision-making and helps them avoid costly mistakes. Perhaps the most important part of the quiet strategy is discipline. Wealth building rarely comes from one brilliant investment. Instead, it grows from thousands of small, consistent decisions made over time. Staying committed to a simple plan often produces far better results than chasing the next big opportunity. Quiet investors rarely try to predict the market. They understand that even professionals struggle to forecast short-term price movements. Instead of guessing what will happen next week or next month, they focus on staying invested for the long run. By avoiding constant predictions, they remove pressure and reduce mistakes that come from acting on uncertain expectations. Another part of the quiet strategy is reinvesting profits. Dividends, interest, and other earnings are not spent immediately. Instead, they are returned to the portfolio to generate additional growth. Over time, this reinvestment becomes extremely powerful. What begins as a small stream of income slowly turns into a much larger engine of wealth. Quiet investors also accept market volatility as normal. Prices rise and fall constantly, and temporary losses are unavoidable. Instead of fearing these movements, experienced investors see them as part of the process. They understand that markets historically recover and grow over long periods, rewarding those who remain patient. One silent advantage of this strategy is reduced stress. Investors who constantly chase opportunities often experience emotional exhaustion. Quiet investors avoid this cycle because they rely on a long-term plan rather than daily decisions. They spend less time worrying about every market fluctuation. Another key element is automatic investing. Many disciplined investors schedule regular contributions to their investment accounts. This simple system removes the temptation to delay investing or wait for the perfect moment. By automating the process, they ensure that progress continues regardless of emotions or market conditions. Quiet investors also understand the importance of time. Starting early gives investments decades to grow. Even small contributions can become powerful when combined with compounding and patience. Waiting too long to begin investing often means missing the most valuable years of growth. Avoiding unnecessary complexity is another feature of the quiet strategy. Some investors believe complicated systems produce better results. In reality, simple approaches often outperform complicated ones. Clear strategies are easier to follow consistently, which increases the likelihood of long-term success. Many quiet investors prefer broad market exposure. Instead of trying to select a few winning companies, they invest in large groups of businesses across the economy. This approach reduces risk and allows them to benefit from overall economic growth, rather than relying on individual predictions. Another overlooked habit is reviewing investments periodically rather than constantly. Quiet investors check their portfolios occasionally to ensure they remain aligned with long-term goals, that they avoid watching prices every day. Constant monitoring often leads to emotional reactions and unnecessary changes. Risk management is also central to this strategy. Wealthy investors think carefully about potential losses before focusing on profits. By protecting their capital and avoiding excessive risk, they increase the chances of surviving market downturns and continuing their long-term plan. Quiet investors also understand that discipline matters more than intelligence. Many intelligent people fail in investing because they act emotionally or inconsistently. Meanwhile, disciplined investors who follow simple rules often achieve better results simply because they remain committed to their strategy. Over time, this quiet approach begins to show remarkable results. While others jump from one trend to another, disciplined investors steadily build a growing portfolio. The progress may seem slow at first, but after many years the difference becomes dramatic, revealing the hidden strength of this silent strategy. Quiet investors understand that wealth is often built through routine rather than dramatic decisions. They follow the same habits year after year: saving, investing, and reinvesting. These routines may appear boring, but they create a powerful financial structure. Over time, small repeated actions become the foundation for long-term prosperity. Another important part of the quiet strategy is ignoring social pressure. Friends, media, and online discussions often promote the newest investment trends. Many people feel compelled to participate simply because everyone else is talking about it. Quiet investors resist this pressure and stay focused on their personal strategy. They also understand the importance of protecting capital. Instead of risking everything on a single opportunity, they carefully evaluate potential losses. Protecting what you already have allows investments to continue growing. Large losses can take years to recover from, which is why cautious decisions often lead to better long-term results. Quiet investors avoid constant trading. Buying and selling frequently may feel productive, but it often reduces profits through fees, taxes, and poor timing. Instead, disciplined investors prefer to hold quality assets for long periods, allowing the underlying value to grow naturally. Another silent rule is focusing on what can be controlled. Investors cannot control market movements, global events, or economic cycles, but they can control savings rates, investment discipline, and long-term strategy. By concentrating on these controllable factors, they increase their chances of financial success. Quiet investors also understand that mistakes are part of the journey. Even experienced investors occasionally choose the wrong asset or miss an opportunity. Instead of reacting emotionally, they learn from these experiences and refine their strategy, becoming stronger decision makers over time. Another strength of this strategy is flexibility. Markets evolve, technologies change, and economies shift. Quiet investors remain open to adjusting their portfolios when necessary. However, These adjustments are thoughtful and gradual rather than impulsive reactions to temporary trends. They also prioritize financial independence over short-term excitement. While others seek fast gains or dramatic profits, disciplined investors focus on building stable, sustainable wealth that supports their future lifestyle and long-term goals. Patience becomes increasingly valuable as investments grow. Early in the process, results may appear modest, but as portfolios expand and compounding accelerates, progress becomes more visible. Those who remain patient during the early years often experience the most impressive long-term outcomes. Quiet investors also avoid comparing themselves to others. Financial success looks different for every person. By focusing on personal goals rather than competition, they maintain clarity and avoid unnecessary risk driven by envy or impatience. Another hidden benefit of quiet investing is confidence. As investors see their disciplined strategy working over time, they develop trust in their approach. This confidence helps them remain calm during market downturns when others panic. Eventually, the quiet strategy becomes a powerful financial habit. Instead of relying on motivation or excitement, investors simply follow their established process. This consistency turns investing into a normal part of life rather than a stressful or unpredictable activity. One reason this quiet strategy works so well is because very few people have the patience to follow it. Many investors want quick proof that their decisions are correct. When results do not appear immediately, they abandon their plan and search for something new. Quiet investors accept that wealth takes time to grow. Another advantage of this approach is clarity. Because the strategy is simple and focused, investors always understand what they are doing and why. This clarity removes confusion and prevents unnecessary changes that could damage long-term progress. Quiet investors also appreciate the value of steady accumulation. Each small investment becomes another building block in a growing financial structure. Over time, these building blocks create a portfolio that generates income, security, and opportunities. They also recognize that financial success rarely comes from one perfect decision. Instead, it comes from hundreds of reasonable choices made consistently. This perspective removes pressure and allows investors to focus on long-term improvement. Another key element is maintaining balance. Quiet investors avoid extreme positions in their portfolios. Instead, they maintain a diversified structure that can adapt to different economic conditions and market environments. Over decades, the quiet strategy benefits from economic growth and innovation. As companies expand and industries evolve, long-term investors participate in that progress. This gradual growth becomes a powerful driver of wealth. Discipline remains the central principle behind everything. Markets will always create temptations, fears, and exciting opportunities. Quiet investors remain focused on their rules and refuse to let short-term emotions influence long-term decisions. This approach also creates financial stability. Instead of constantly risking large losses, investors build a balanced portfolio that can withstand difficult periods while continuing to grow over time. Another benefit is freedom. As investments compound and portfolios expand, investors gain more control over their time and choices. Financial security allows them to focus on what truly matters in life. Many people search for secret formulas or complicated strategies, but the quiet truth about investing is surprisingly simple. Patience, consistency, and discipline outperform excitement and speculation. Those who commit to this silent strategy often look back years later and realize how powerful it truly was. While others chase trends and temporary opportunities, their steady approach quietly built lasting wealth. In the end, the quiet investment strategy is not about being clever or lucky. It is about staying consistent when others are distracted, patient when others are impatient, and disciplined when others are emotional. Over time, these simple habits quietly transform ordinary investments into extraordinary results.